let's look at an example of a basic accounting equation being affected by various transactions. The question asks us to show how each one of the transactions affects the financial position of the company, meaning affecting our assets, owner's equity, or liabilities, and we need to make sure that we can clearly indicate which element is being affected, and it's whether it's being increased or decreased by each one of the transactions. So to start off with, what I have done is prepared a template that would much resemble of what you would set up in an answer in an exam or in a question to an assignment, where we've got our assets, we've got our owner's equity, and we've got our liabilities. And then underneath that, I've gone one step further, just for this purposes of this example, to show whether it's going to increase with a plus or decrease with a minus. Remembering that each account also has a debit or credit side to that element. Why is that important? Because notice that when we cross the equal sign, we've got assets equals owner's equity plus liabilities. When we cross the equal sign, what happens to the plus and the minus? They reverse. So then it becomes minus plus, minus plus. So under owner's equity, it decreases on the debit side and it increases on the credit side. And liabilities the same. Decrease on the debit side and increase on the credit side. Whereas assets are the opposite. They increase on the debit side and decrease on the credit side. So it's important that we know that distinction when tackling each one of the transactions that are going to follow. And this template helps us to guide between each one of the transactions. So let's now go look at the first transaction, and it says to us that the owner deposited 150,000 Rand cash into the business's bank account on the 1st of January. The important thing is to establish which accounts are being affected. So if we have a look, it says to us the owner deposited cash, so we know cash immediately relates to our bank account. Okay, and it says into the business's bank account. Whenever we hear the owner is putting money into the business, he is investing capital. So when we see the owner putting money into the business, we must understand that that is capital contribution. Okay, much like if a shareholder were to put money into a company, he would be giving some capital and buying a share into the company. Alright, so let's have a look then how this is going to increase or affect my accounting equation. Right, let's have a look. Okay, so the owner put in 105,000 Rand as a capital contribution in cash. Cash we know is an asset unless told otherwise, unless we're in overdraft. So our assets are going up. That means they are going up by 105,000 Rand. We again will just show that plus sign to make sure that we know that it's increasing. Okay, what else was happening? He was putting in capital. Capital is part of his claims on the business. So it's his owner's equity. What's happening to the owner's equity in the company? He's putting money in. Therefore it is increasing. So it is increasing by 105,000 Rand. What do we notice? That the left-hand side of the equation is increasing by 105,000 and the right-hand side of the equation is increasing by 105,000. So it's in balance. Okay? If we look at the second question then, we see there that the business bought 450,000 Rands worth of inventory. Immediately we can see the one account is given to us is inventory. We need to ask ourselves, how did we pay for that inventory to give us the second account? And it says from various suppliers. However, 80% of it was on credit and 20% of it was cash. So very importantly, we need to be able to now split that 450,000 Rand into its two elements. Okay, so we need to perform a quick sideline calculation, and that would always need to be shown in a test situation because we want to be able to show the marker that we have given each part of the calculation. So they said to us the 450,000 Rand was split up 80% credit and 20% cash. So how do we work that out? We say, well, 450,000 times by 80% or by 0.8 gives us 360,000. If we say 450,000 times by 20% or 0.2, it gives us 90,000. So 90,000 would have come out of our bank accounts, whereas the 360,000 Rand would affect what we call our accounts payable or creditors, because it is on credit. So now we're going to transfer that knowledge onto the accounting equation. Right, so we said to ourselves, what has happened? We bought 450,000 Rands worth of inventory, meaning our assets, because inventory is something that we own and expect to have economic benefits from. Okay, so 450,000 Rands worth of inventory has been purchased. However, it wasn't all purchased cash. We said to ourselves that 90,000 Rand came out of my bank account, which was cash. Now remember, bank would be going down because I am paying for it with cash. Only that 20% though. Okay? The remainder was by utilizing a credit facility with a supplier. So that 360,000 then would have increased our liabilities, because now we have an obligation to pay that supplier with the amount of 360,000. Let's have a look and see what has happened now. Okay, if we see what is happening on the left-hand side of the equation, our assets went up because of inventory by 450,000. They went down because I paid for that inventory out of my bank account with only 90,000 Rand. The net effect is that they have increased by 360,000 because it went up by 450 and down by 90, giving us a net effect of an increase of 360,000. What do we notice is also happening on the right hand side of the equation? We've also increased our credit facility with an accounts payable or a creditor with 360,000. The equation still balances. It increased by 360,000 on the left hand side and 360,000 on the right hand side.